pace of change has been so, dramatic. How do we, how do we adjust, as a business or as an industry? And so that's where we've really kind of planted our flag as a company. We want to be in the, we're in the relationship business. We're not a transaction business.
Welcome to Teague Talks. I'm your host, Teague Hunter. Today we're talking with David Turley, President and CEO of Cronheim Capital, to talk all things lending. Lending is so important today. I think we need to learn everything David will share with us. Thanks for joining. Thank you for coming on. This is great. I'm going to get into debt and finance and the numbers and all that kind of stuff because that's what everybody cares about. And full disclosure, everybody, Cronheim Capital, David Turley, the man, really made that business what it is, in my opinion, today. Friendly competitors, if I can, but we were friends, so I'm having my friends on because we do capital markets too. So I want to talk about capital markets, the money flow, and where it's all going and what you looks like. But as always, I got to start with who the heck is David Turley and how did he end up in this wonderful job in this wonderful industry that we're in? So give me the life story of David Turley.
The whole thing, huh? I'll condense significantly.
Give me a condensed
and
version.
I'm
I'll take the condensed version.
Condensed version. This is admittedly a very unlikely path. So before I embark upon this, I'm not making it up, actually.
Well, good disclaimer. Good disclaimer.
Yes, that's right. I'm from suburban Atlanta. Grew up in Cobb County. Generations of us Turleys are from the Southeast, and I went to school at a small liberal arts college at the time called Asbury College, now Asbury University in Kentucky. And I was 21 when I graduated, and I recognized that coming from kind of far-flung Northwest Atlanta, to a more far-flung place out, outside of Lexington, Kentucky, that my my education was not complete. And so I took about 8 months out of the next year and a half after graduating and backpacked all over Europe and the Middle East. And two different trips, and just kind of explored the world and saw stuff I'd learned about. I'm a history major, so I don't have a finance kind of economics background or business background. So I had a very non-vocational, education that I then, kind of explored all this stuff, in my travels through Europe and the Middle East. And I ended up in Jerusalem, kind of at the tail end of my trip, as measured by the amount of money I had left to continue doing this trek. And as things were coming to a close, I was like, interviewing other travelers, like, hey, what should I do when I go back home? I've kind of come to the end of my vision, really. I didn't have a very vocational focused vision. And one traveler was like, she just graduated from Georgetown, and was from New York, actually. And she's like, I think you should move to New York and do investment banking. And I was like, that's so nice. What is that? And she didn't really explain it very well, but I went home and I was like, I'm gonna move to New York and I'm gonna do investment banking. And so through a couple of very random connections, I ended up doing real estate investment banking at a firm called Cronheim Mortgage in the suburbs of New York City. Coming from Atlanta, I thought, if you're 15 miles away, you must be, I was like, I'm moving to New York. And people were like, no, you idiot, you're moving to New Jersey. But it was close enough. And that was 24 years ago. And I'm still commuting to the same building.
This is my point, though. I love it. This is where I love these stories. And one, I love doing this because I learn something new every time. I didn't know your backpacking trip, and that's what got you there. But but I know you've been with Cronheim for 20 years and started out as the dishwasher, which an analyst, and moved up, and now he's president and CEO. So I love those stories. Love those stories.
Yeah, right? From the ground up. I didn't know. I was here for a month. Going home and reading, as much supplemental stuff as I could about the real estate industry, because I kind of stumbled upon it, and after a month, I sat down with a guy that I was working closely with, and I was like, okay, I think I understand what we do, and I'm going to like say it, and if I'm wrong, you got to like correct me because I had to basically in my own the way I was thinking was to kind of continue my education. This was just another step in my life education, and I wanted to go learn business and finance and real estate investing, and then some years later, we'll say that it, was well. I mean, it was somewhat precipitated by my backpacking experiences and just traveling around and having getting a travel bug. So I got introduced to the hospitality industry through some folks that had some hotels and other asset classes here in New Jersey, and we financed a couple of them. And I was so intrigued by this hybrid real estate, asset class. It's both a business and an operating business and a piece of real estate combined, and it's also more it requires there's more levers to pull. I would say it's more manipulable perhaps by with kind of good operations and good management in a way that other asset classes are a lot more standardized, commoditized.
Yeah, I gotta echo that again. So Cronheim, when you joined them, was doing all real estate classes.
Correct.
And back then, that was called not hotels. To your point, that was operating
Correct.
business. So they were doing office, industrial, retail, multifamily, just those down. And to this day, they still do those as the core business. But you brought in hospitality. And now I would argue hospitality is 50% of what the company does. But you give me better facts than what I just spit out.
Yeah, it's more than like 2/3 to 75%
Yeah.
depending on the year, and
Yeah. Yeah.
we closed just over $1 billion of hospitality transactions last year, coast to coast. $120 million deal in Chelsea on a Renaissance hotel and a $4.1 million Fairfield outside of Montgomery, Alabama, and a lot of things in between. So we've we have built from fairly humble beginnings in the hospitality world. We've built kind of a national platform. Um, and backtracking slightly, so we covered all asset classes. Hospitality was not as institutional an asset class at that time as it is now. Um, and we got into it kind of at the right time when it was arguably institutionalizing. And the flows of capital were very intermittent at the time from kind of um, anything but kind of local regional banks, that were kind of doing recourse lending to hospitality developers, and the CMBS markets or the life insurance company markets or the structured finance markets would be there occasionally, and then they would retreat, and then they'd be there occasionally. And so we got in kind of as that dynamic was happening, and felt like the space was really interesting, and also I felt like was ripe for somebody like us to bring more of an institutional background into the space, and kind of do what we did for other asset owners.
I love that story. That's why we exist too, right? Like the
Right.
industry just evolved. That's why Cronum exists. That's why Hunter exists. Like I keep joking, in theory, we shouldn't be here, right? We should be crushed by all
Right.
the big boys that are trying to do this. But it's this Wall Street to Main Street intermediary that I think there's a real need for, right? They need the institutionalism that you guys are bringing. Sorry, I interrupted.
That's right.
Continue.
No, we felt like the experience with other asset classes, the broader capital relationships, because most capital is doing diversified investing, not like single asset investing, and so they're like, hey, I got to fill up my buckets of multifamily, office, retail, industrial. I will, I want hotels as well, but I really want somebody who can ideally bring me kind of all of those things, and since that was our total flow of business, we just had you know maybe some more better alignment with the capital sources that we were ultimately bringing to our clients, and the value of those relationships and that market credibility going back for decades. The Cronheim family, whose name we use, got into the mortgage banking business in the 1960s. So there's decades of credibility and kind of carefully built reputation and relationships that we've kind of been able to bring into the space.
So you know what? Go to that. How did this family, if I may, allow an
Mm-hmm.
outsider come in and and grow this business and build it to what it is today? What did they see in you? Why did they believe in you to give you the keys to say, go, good luck?
I mean, obviously started small. So, at first they gave me the keys to a cubicle with which I could sit and do a bunch of, real estate spreadsheets. Um, but the Cronheim family has not operated the business for decades. And so there was a guy named Andrew Stewart who was operating the business we paid them effectively kind of a licensing fee to use
Yeah.
their name. And so he was kind of operating it and took a bet on a guy, with a history degree out of Atlanta that he was going to have to kind of allow to learn from the ground up. And after some years, I have very kind of entrepreneurial bug. And so I kept thinking about ways in which I could kind of improve and kind of explore different things and do things differently. And that again led to the hospitality space.
But who's your core client? Who calls this? David, I need your help.
Um, I mean, generally, it's a lot of mid-market kind of owner operators on up to kind of the larger institutional guys that, some cases have, in-house kind of finance groups, but those groups, can't have the exposure to the full wide market. And particularly right now, that's kind of what it takes. So it's, we've done deals with guys that own a couple of hotels and they operate them all and live right down the street. And we've done, deals with, huge kind of, big guys kind of that act as promoters, kind of with big institutional capital behind them and they buy and, fix it up in order to promote. And we've done deals with, big, kind of asset aggregators, the MCRs and the Concords, et cetera.
So what does let's talk about what the world looks like today. So what does the world
Mm.
look like today?
We are super busy because everyone is having a hard time finding capital. And capital is the key that unlocks, so many things, right? I mean, your buyers are struggling to find the capital that makes sense to pay the prices that they may want to pay for the assets they want to acquire. Developers are trying to get, selectively, but they're trying to get, deals off the ground, and they're like, I can't afford to pay some, the rates they're finding out there. Even guys with maturing loans, they go back to the existing lenders, say, hey, let's just roll it over. Existing lenders like, no, sir. I've got a mandate to shrink my hotel book. I want this off my books. Um, and so, they make a few phone calls themselves. Perhaps they're not hearing what they want to hear, and they come to us. Um, in general, I mean, the market is evolving so quickly, but in general, let's do an update since, Hunter, when I sat on the panel with a couple of the other kind of finance guys. And, that time interest rates were expected to drop by the end of the year and, help was on the way. And if the US economy held up in the meantime, bonus, right? Um, as of today, those rate cut, dreams are kind of evaporating. And so are a lot of the optimism, that help is right around the corner, and that today's interest rate, while painful, is going to yield is going to lead to borrowing at much cheaper rates in 6 to 12 to 18 months. Let's just hold on and we'll this will ebb just like it flowed, right? I think there's a lot of guys that is, I guess, created a couple of things. One is created some capitulation. Like if things are not going to get better in the next 12 months, or I'm less confident they will, maybe, I should hold off. I should not hold off making these big decisions need to be made. Maybe I just need to kind of bite the bullet and figure out a way to justify them based on today's conditions. Because what we do have going for us today is we have, an economy that's resilient beyond all expectations. So with that, and with people traveling, and generally property performances are strong um, relative to 2019, and in most cases previous years. Maybe we start making some of those decisions now. Maybe, and this is the damper. Maybe if I buy this asset with today's high interest rate, I'm not going to swap it out for a much cheaper rate in 2 years that's going to justify me paying the price I'm currently paying. Maybe my exit cap rate is not, what it was, in 2018, 2019. Maybe it's structurally higher. But all those uncertainties, the more uncertainties, the fewer long-term decisions you want to make, irretrievable decisions you want to make.
Yeah.
And so, and we're seeing that on the lending side as well as, kind of the owner operator side as well, the investor side, because some lenders are like, I don't know, I want to do a lot of fixed rate lending if in 6 months rate could be higher and I'm going to look stupid having put out money at 7% when I'm now in an 8% interest rate market, right? Or yeah, maybe I need to be underwriting a lot more conservatively because the exit cap rates that these, deals are going to be refinancing at, or the interest rates they have to meet a DSCR on is just going to be higher than, what I've been assuming was going to happen in a couple of years. So maybe we should just lower the leverage of everything we're working on. And so, with every kind of false hope of immediate rate cuts, this conservatism gets deeper and deeper. So, all that being said, there's still plenty of capital out there. There's a lot of money that has been sitting on the sidelines that wants to get a yield. Banks are still lending, although much more selectively. CMBS has become a lot more relevant in recent months as those spreads have come in and benchmarks have come down a little bit from their highs. And there has been a lot of on the demand side for the mortgage bonds that back CMBS. There's a ton of that demand, and investors really do want to put money out. And so CMBS guys are pushing harder and harder to find product because they have a very valuable product that they can sell into the bond market. And even insurance companies, somewhat reacting to, I made an office joke earlier, right? Somewhat reacting to the need to find other asset classes that work to lend money on. Like, I mean, there are guys who are like, listen, I can't do another office deal, for 5 years because I've got, I've got a big office portfolio and it has 5 years of term remaining. And until all that stuff rolls off, then I can, free up the capacity. Like, we're not touching office, but I've got a big book of it. So what am I going to replace that with in new originations? And so we've got guys who just very conservative life insurance company lenders who are kind of coming to us, saying, hey, I think we're going to get into the hospitality lending space. In one case, I've been doing some tutoring sessions on like how to evaluate credit risk for hotels because these guys are like, we're going to do it. I've never done it before, and we're not really sure what we're doing, but we're going to dip our toe in the water and see how it goes. Stuff that we would never have seen previously.
Seem like I'm going to start with there's so much capital out there. You just said it. There's the irony, right? There's just so much capital out there right now. We're seeing the on the debt side, we're seeing the debt funds get very aggressive. All the stuff we used to see on the equity side, the private equity side, we're now seeing on the debt side. Hey, we've got all this capital. We got it. We've committed that we're going to do all these deals, and we haven't done these deals. And I get that on the equity side. It's interesting to see it on the debt side now and to watch these debt funds get very aggressive now trying to lend. I mean, relatively speaking, it's still very expensive, right? It's still SOFR 400. I'm going to ballpark that number, right? So that's 9+%. So that doesn't feel aggressive. Right. But to your point, they want to do it. CMBS wants to do it. Even the life codes are showing up wanting to do it. Everybody wants to do that. I guess they just can't find deals. Maybe you were right. They can't do it in office anymore. So now they're coming to hotels. I don't
some of it. I mean, in some of the pitches is fairly simple, So the pitch to the capital that's behind all these debt funds. We'll pick on them for a second. You're like, hey, I can give you double-digit yields, taking a senior secured position on an asset that we're not sure about capital appreciation. We don't know what the exit cap rate is going to be. It's going to be hard for us to do value add investing requires us to, load up on 10, 11, 12% debt, so we got to sit behind that. And then we have to earn our yield. Like all those are, those are risky moves. But if I give you 10% cash on cash return and you sit on the debt side of the equation and you got a bulletproof basis, like what's wrong with that?
What's wrong with that?
And so they've raised a ton of capital, on that premise. And I think, I mean, it makes sense. Makes a lot of sense, frankly. And then they're leveraging up those positions in many cases using kind of warehouse lines or, A notes, depending on how they're capitalized. And then in some cases, getting to the high teens to 20% yields as the subordinate piece of these loans, again, sitting in a, debt position with last dollar, 65, 70% loan to value, earning equity yields. So if you're a big, kind of money manager, would you rather make, kind of equity risks, equity bets right now on kind of a, uncertain future, or do you want to just take a solid 15 to 18% cash on cash yield and right and do debt? So that's the pitch, the value proposition, if you will, that is fueling a lot of the liquidity we're seeing in the debt fund space.
Yeah.
And they are getting aggressive partially because they've loaded up on capital. Now they got to go find deals. And there's more and more competition out there to do these things. And rates, those spreads are really 400 at the kind of the low end, up to 6 to 700 over, depending on the deal and the risk profile. So if you're borrowing construction, for instance, from a debt fund, you're borrowing in the high sixes to mid sevens over, and then guys are using as best they can C-PACE to kind of blend down the cost of that capital so that's a little more manageable. But if you're, I mean, you're 750 over, a 5.25%, SOFR, and you're like, you're pushing 13%. I mean, that's getting very well paid.
Yeah, that's expensive, right? And on your 2-year construction project or something like
Yeah. I
that's
mean,
expensive. How
it's
much? So how much? Let's stay on construction and development. How many deals? How many requests are you getting? I mean, what I'm saying is, it feels like the money is there, but it is so expensive that the borrower doesn't want to borrow it. Is that accurate?
there is a there is a pricing problem, right? Uh, with a lot of things that could be would be done if you could borrow money at 8% for construction.
Right.
All kinds of projects would be happening right now. That said, we're busy with a bunch of it. I mean, we're doing development downtown Knoxville, downtown Atlanta, Center City, Philadelphia, suburban New Jersey, and those are all hotels and other asset classes. Indianapolis and South Texas and Cleveland and Eastern Pennsylvania. Multifamily and self storage and obviously hotels. So there is plenty of that we're seeing. Again, we've not traditionally historically done a ton of construction stuff because it was just too easy to go to your local
Right.
bank and get them to throw money at you. But
Right.
in today's world, it's very difficult for these projects to pencil. And so, if you're not casting a really wide net and kind of exploring every option, then it's there really difference between viability and no viability.
Where else are you
Yeah.
seeing your volume? Like, give me your volume. How much of it is refis? How much of it is acquisition? How much of it is development? On the sales side, they call, hey, we tried to refi, we can't. The bank
Yeah.
doesn't want it. To your point, they want to get paid off, and so they're calling us. That and the construction loans, the one that is opened, that has been open for a month or 3 years, and somehow isn't working to pro forma, and so the bank wants a pay down slash a pay off, and those guys are being forced to come to market. So, are you guys seeing some of the similar stuff?
Yeah. I mean, there's a lot of refis as
Yeah.
a result, right? Like CMBS is kind of a hard stop. It must be paid off. There's
Yeah.
we've seen extensions on very rare occasions, but you're playing with fire. And so people stay away from that as if at all possible. And even some of the there's a lot of banks that are just sick of extending loans. Like, hey, if we've done this now 2 or 3 times, like, now you got to pay me off. And the bank holds leverage, right? I mean, they've
Yeah.
got remargining potential requirements. They got guarantees. It's hard to tell them to go pound salt. So,
You got to hold, right? You got to hold, like the next light at the end of the tunnel doesn't feel like it's till 26. I mean,
right,
I know it depends. Maybe we should talk about markets and but it depends on where you are. But I think you're holding that far, that long. I really do.
right,
So you got to get through the balance of this year where we think we see no rate decreases. I'd love your opinion, but I think everyone's come to that consensus. So no rate decreases. And then it's next year, maybe you have some. Um, but you still need the revenues to stay strong. You can't have the rates decreased because the economy has slowed, which means your revenue or your rates have slowed, right? See, that's what you got
that's
to
right.
get through lowered rates plus increasing revenue, which anyway, that's somewhere we're going. That's what we're seeing. So we're seeing out till 26. Like that's when the light at the end of the tunnel, not next year. And it was survive till 25. And now we're like, oh, well, okay. Maybe 26. What do you guys see?
Yeah, I mean, a lot of the same things. Everything I read suggests that like what should the Fed be fixing right now? I mean, maybe
Yes.
a banking issue that's kind of brewing, but there's nothing wrong with the jobs market. There's nothing wrong with the economy. Inflation seems to be, I mean, if anything, you might need to put a little more gas on the fire in the form of rate hikes but those are, I think there's a lot of people insulated from rising rates. I mean, the truth is rising rates have probably helped you and me personally because we hold assets that have benefited from it. And we locked in all of our debt or don't have a lot of debt, and we locked in a lot of our debt at low rates. So it's not a super effective instrument, it doesn't seem. But it doesn't seem like, to your point, the rates are going to be coming to our rescue in 25. And I do wonder, we're not talking about it a lot, but maybe going forwards, we don't get Goldilocks. Maybe going forwards, it's either you got to pick your poison. Do you want a low rate or do you want declining performance? You pick. Do you want low rates with declining performance or do you want, positive, cash flows with high interest rates? But you can't have both simultaneously. And we've come from a world where we've had both, right? It's not some blistering growth, but you get a couple of points of growth every year and your expenses are in check and you get to borrow money at 4%, like what's wrong with that? But maybe in going forwards, like, if something breaks, they'll fix it with lower rates, but now you got something that's broken.
Yeah, that's what we keep screaming. Something's got to
Right.
break before them to lower rates.
Right.
And to give the same analogy on the asset side, do you want cash flow, but a higher cost per key? Or if you
Right.
want a low cost per key, below replacement cost, that typically comes with no cash flow or
Right.
little cash flow.
Right.
So pick your poison. And how long do you see it? How long do you see this market being where it is? I want to ask you about CMBS rates, where you see that. And I sort of want to compare that to the debt funds, but I think that's a fun conversation right now. So talk to me about the CMBS
Sure.
market.
So, we did $1 billion of hotel loans
Yeah.
last year. We closed one CMBS loan,
Okay.
one.
Yeah.
Because, who wants to lock up money at, 7.5% to 8%, 7.75% to 8%, 10 years, right? Um, and with CMBS, it's hard to get out of. So, like, you're stuck. What CMBS has done, more recently is come out with a 5-year product. It's generally interest only, which kind of takes the sting out of, paying something in the sevens on interest rate. So, it's right now 7.25%, 7.5%. Depending on cash flow. I mean, there are properties that actually have, some stuff that's trying to get refinanced is 16, 17, 18 debt yields, just super low leverage stuff that for whatever reason the bank doesn't want. Um, and that gets done in the high sixes. So, you've shortened the duration of your suffering to only 5 years with CMBS, and you made it interest only, and that's actually particularly depending on where you are in terms of your banking exposures or your the amount of recourse obligations you have on your balance sheet, or maybe you want to cash out some, which your local bank is going to struggle to let you do. CMBS is now suddenly much more viable.
Yeah, that's why I love this conversation. And obviously biased. We're typically not CMBS fans, right? Because I
Right.
don't think you
Of
should lock
course.
in, right? I think flexibility is worth it. But let's just run the math for fun. CMBS 5 years, if you can get the 5 year product, CMBS 5 years. You just said seven and a quarter, seven and a half.
Hmm.
Or I'm going a debt fund or something where I'm at SOFR 400, even on the best. So I'm at nine and a quarter, nine and a half. So seven
Right.
and a quarter, seven and a half, nine and a quarter, nine and a half. I'm 2 points better. Okay, I'm locked in for 5 years, but how are rates, are debt fund flexible rates really going to come down to anywhere meaningfully close in the next, okay, 5 years? Like, and maybe they do, but every day that I clip off on the front end is a day I can add to the back. Go. I might take
Well,
the money.
that's before you pay the point in, the point out, and you
Yeah.
buy a rate cap,
Yeah.
right?
Yeah.
So that's another 2.5, 3 points, right? And then you're committing to do it all over again in 24 months. Your debt fund will give you 3 +1 +1 generally, but you're going to pay for the extensions. There's
Right.
generally a rate floor. So you have to in my mind, you have to really want the flexibility. And some people do, either they're betting on rates or there's something coming up that they need to have the flexibility for. But if you're like, if those things are still big question marks, it's just a lot cheaper to go, 5 year fixed.
I agree. I mean, again, if you're not planning, if you know that you're not going to own it for 5 years, which again is only 5 years, 10 years was always a non-starter for me. I'm like, you're not going to own it
Correct.
that long. I don't know why anyone did that, but that was the product. It was cheap. It was like the drug. Everyone took it. But 5 years seems doable for me. You're going to probably own it for 5 years anyway.
That's right. That's right.
And even today, I would argue that the defeasance isn't that bad. I think. I mean, if rates lower, yeah, you're going to get caught with some defeasance, but I don't know. Maybe I just fundamentally think this is a new world. I think these are the rates. I think these are the rates where we're going to be.
Right.
I think this is the new norm. And I guess if you disagree with that, then don't lock in. But I think this is a new norm. And I think the yield curve agrees with me, right? I mean, talk about the yield curve. It's gone up. What's your take on that? A year ago, everyone thought rates were coming down. And now the yield curve seems to agree that rates are not coming down.
Yield curve has no idea. Like the bond market is hoping, and then they bet, they get disappointed, they bet all over again, they get disappointed again. I think, I don't know if you're right or not about where rates are going, but I do know that the cost of not locking in, in terms of of maximum flexibility is
Yeah.
very high.
Seems very.
Now that said, what we've been doing a lot of over the last couple of years is what I think of as like fixed rate bridge lending. So you go to a local bank or a credit union or credit union syndicate, and you get almost nothing in the way of prepay. And if you're willing to sign and your deal's not, above 25 million bucks, then that gives you the stability of a fixed rate in today's world, but a lot of optionality that in the event, things change, whether your circumstances change or interest rate change, you can go, get out of it and go get something much better. So I think that's the best of both worlds. But if you're having this I have to borrow non-recourse, or it's a larger deal size that the banks are not going to do, then you can bet on rates, but the cost of that insurance policy is much higher.
How about local banks? What do you see with local banks?
We're still doing a ton of that. It's spotty though. Last year we did a lot of local bank stuff all over the country, and we've found a way to kind of access that money everywhere. But banks are pulling back. They're pulling back because the guys are doing hotels, have kind of done a ton of them, and now they're up to their eyeballs, or they're concerned about where rates are going as well. And they're kind of say, hey, I'm not sure how much more fixed rate lending should we be doing right now.
We're seeing the same thing with local banks. We
Mm-hmm.
we loved all last year. I'm going to echo all last year was local bank, local bank, local bank,
That's right.
and they seem to be drying up.
That's right.
So, and I don't know. I don't really think they're struggling, but whatever. But I think it's more that what you call the cap. hey, we've lent too much on too many hotels. We're not going to lend anymore. How much, even I'm thinking Wells Fargo's and the like, which is funny because those guys have tightened, right, on who they lend to. Only the best of the best clients on the best of the best projects. And when they do it, then they'll lean in very heavily. But it's hard to get anything from them. And then we've learned that there's like a seasonality out of this stuff, which is kind of weird, that they fill up in the beginning of the year and then midway through they get full. And so the back quarter, if not half, they won't lend. Sorry, we lent everything we wanted to lend. And we've done it enough years now that it's a self-fulfilling prophecy that come the first quarter, everyone's like, I got to go. I need it right now. I need it right now. I need the money. And they get it knowing that they're going to fill up. And then inevitably they fill up and they don't lend anymore. Is that, am I right there? Is that going to continue?
It's the old life insurance company thing. Like back in the day, these guys they'd have an allocation and they would like bust it to get it done the first half of the year. And they'd play a lot of golf in the second half, like what a great life. So, I don't think that's exactly what they're doing, but like there's so much demand for that capital that when they're open, they're swamped. And you have to be really, really disciplined to have money and not lend it because you're waiting for the right things. Keep in mind that the difference between like the big guys and the much smaller guys is the way they're regulated, and also the size of their problems relative to the size of potential bailouts and other things that the feds might have to step in and do. So there's a very short leash for some of those big guys, and the reason they're so specific about who they lend to is because they're also struggling to make money on doing mortgage loans. There's not a lot of net income smart. They want to do loans for people they're doing a lot of other business with and making money in other ways.
Wrapping up, but what's your future? Give me some other predictions, some bold David Turley predictions for the balance of the year.
I think what you do and what we do is going to be an increasingly high demand because I think the world's going to stay super fragmented and there's going to be a lot of need for both, transactional kind of advice, but also strategic advice.
Yes.
Like, how should I be thinking about my world? How are other people that have similar in some situation, how are they thinking about their world? What's, how do the pace of change has been so dramatic. How do we adjust, as a business or as an industry? And so that's where we've really kind of planted our flag as a company. We want to be in we're in the relationship business. We're not a transaction business. People come to us for transactions. We get transactions done. We're very, very good at it. But we really want to be in the advisory business. How do we help people make good decisions for themselves with regard to debt structures and who to transact with, but also just, their worlds, part of what makes us good at that, hopefully, is just being really well-read and thoughtful. And part of what makes us good at it is we just talk to a lot of folks in our business, just as you do in yours. And so you kind of generate we become I would say a repository of collective wisdom.
Yes.
Right. Where people kind of give us their best thinking that we can then distill and help people, kind of spread that around, ultimately, hopefully for the good of all of us, so that we all succeed together.
Yeah, that's very well said, actually, sir. And I'll echo that. What's funny, when I was coming up, we used to be the advisory and of sort of Main Street, right? They didn't really know. We knew a little bit more than they did because we were talking to all these people and we had some communication with Wall Street. And so here's what we see. And today we seem to be advising Wall Street more than we are Main Street.
Right.
And I don't know if that Main Street just got smarter and figured it all out, or if Wall Street just doesn't know and they just make billion-dollar bets. Who knows? And they're all wicked smart. They really are. But they make these big bets. And now they're trying to unravel some of this stuff that they're doing. Right. We're having really in-depth strategic conversations over a lot of assets with a lot of different people, the Brookfields, the Blackstones, the Starwood Capitals. These are really smart entities, but they've got lots of complicated decisions they're trying to make at the moment. So I don't know. So we're in deep with those guys. David, this is super. I appreciate everything you do.
Really, really fun, man.
Yeah. Stay safe. Thanks for doing this. Thanks for letting me talk to you.
Yeah, of course. Yeah, of course.
Okay,
guys. Thanks.
Bye.